In question number 6, we have been given 5 adjustments: pass journal entries and prepare final accounts. So without passing journal entries also we can do adjustments and prepare the final accounts. That's how we can do for comprehensive illustration. But better understand how do I pass journal entry. After passing the entry, how it could have been in the trial balance if you are aware about those adjustments beforehand. And from that adjusted trial balance, how can we prepare the trading and P&L account and balance sheet? In such a manner, we will be solving these illustrations for your better understanding. Let's see here. Closing stock was valued at rupees 3,000. Whenever there is an adjustment for closing stock, you better adjust the opening stock also. The opening stock and closing stock both will be adjusted and routed through the purchases account, right? Opening stock will be addable with the purchases and closing stock is subtracted from the purchases. And further, the journal entry being very simple, right? For the stock. For opening stock, it should be addable with the purchases, no? So purchases should be debited. Purchases account debit to opening stock. The value being 1,000 rupees. 1,000 rupees. And the journal entry for closing stock here being, closing stock account debit. Closing stock account debit to purchases. The value being 3,000. With that, adjustment related to the stock is over. Closing stock of stationery was valued at rupees 450. How do we handle for the closing stock now on stationery? Also similar. Usually whenever you are purchasing the material for the resale purpose, the purchases of material is now debited to purchases account. But for the consumption purpose, if you are getting any material, the debit item will be in the same item itself. If we could have purchased the stationery for the consumption, we might have debited the stationery account. Is that okay? That stationery in the trial balance being 800 rupees. What does it mean? This 800 rupees could have been the purchases. The purchased stationery may not be the expenses, right? Because only to the extent of materials consumed will be the expenses. So we have to do some additions and deletions with respect to the opening stock as well as closing stock of stationery with this to find out the expenses. The opening stock should also be addable with this, right? Isn't it? In the year beginning, we have 250 rupees opening stock. Then we purchased another 800 rupees worth of goods in that year. So 800 plus 250, we have 1050 rupees worth of goods. In the year, we came to know that 450 rupees worth of goods still pending. What does it mean? You have to subtract that. That's not as expenses, right? Those stationery remains unused. Could be usable the next year. Right, so anything usable the next year, for the current year, it's not an expenses, it's an asset. So that 450 should be subtracted, then ultimate expenses for the stationery being only 600. Right, usually what you do, opening stock plus purchases minus closing stock is the expenses can be debited to the P&L account. In such a way, you can post in the comprehensive illustration. But when you want to pass the entry, you need to understand the logic of entries also. The logic of entry here is just similar to the closing stock. So the opening stock of stationery will be addable with the stationery, no? So for that the stationery account is going to be debited. Stationery account debit. Okay. Stationery account debit. To what? To what? Opening stock of stationery. Opening stock of stationery. Opening stock of stationery. Okay. Similar to the purchases to opening stock, right? The same will be repeated here too. Here too. Is that okay? But rather than purchases, I am debiting the item's name itself, right? The value being 250. The value being 250. And for the closing stock, the entry being, come on. Oh, yeah, very good. So closing stock of stationery account debit. Closing stock of stationery account debit to stationery account. To stationery account. This value being 450. 450. Is that clear? 450. Now we have handled the adjustment entry for the stationery. Write off 100 for bad debt. 100 for bad debt. And provision for doubtful debt is to be maintained at 4%. To write off the bad debt, what we do? If we don't have any provision, first of all the bad debt should be adjusted or routed through debtors. It will reduce the debtors balance. And then the bad debt will be routed through PDD if we have the provision. If we don't have the provision, it may not be debited to the P&L account. Right. Now, just pass the entry for the bad debt. First of all, it reduces the debtors balance. So we have a debtors of rupees 1000. We came to know some of the debtors worth rupees 100 may not be realizable. Could be assumed to be the bad debt. So I am going to pass the entry for that. Yeah, come on, pass the entry for the bad debt. Bad debt is an expenses. So I debit the bad debt. Bad debt account debit to debtors account. To debtors account. This value being 100. The next entry being this bad debt should be adjusted in the PDD account if we have the PDD. Do we have the PDD? Of course, we have the provision for discount on debtors. Provision for discount on debtors. Doubtful debts. Provision for doubtful debt is 150. How much bad debt we have? We have already 100 rupees bad debt, and currently and another 100 rupees also we have. These 200 rupees could be now adjusted through the provision for doubtful debt. So the entry being PDD account debit to bad debt. How much is the bad debt? Existing 100 and new 100. So in total we have 200 rupees. So we can debit to PDD account directly 200 rupees. But the PDD is not sufficient enough. So 150 can be debited, another 50 could be debited to the P&L account, or you can pass a separate entry. Debit PDD completely. There's a shortage of 50 to be now adjusted. Shortage 50 to be adjusted. While adjusting that, the fourth adjustment entry will also be incorporated. The provision for doubtful debt is to be maintained at 10%. Already I told you the method of preparing a working note for debtors. Debtors here being how much? 1000. From the 1000, what we have to do? We have to adjust the bad debt given in the adjustment. Bad debt given in the adjustment, which is 100 rupees. Am I right? So 900 rupees. From there, provision for doubtful debts should be maintained. The provision for doubtful debts should, to be maintained here is 10%, so 90. 810 we have. 810 we have. And fifth point is all about create a provision for discount on debtors. Okay. And reserve for discount on creditors at the rate of 5%. So minus provision for discount on debtors, which is 5% on this. 5% on this being 41 rupees. Am I right? So 40.5. I may round off to next whole number 41 rupees. Is that okay? Now I have passed the entry for bad debt given in the adjustment. The entry for bad debt given in the adjustment is nothing but bad debt account debit to debtors. And later, the bad debt should be routed through the PDD account. So PDD account debit to bad debt is over. And later, verify the amount required to be maintained in PDD. How much PDD we have to maintain for the next year? So we have to maintain how much? 90 rupees. Am I right? 90 rupees required to be maintained. Already there is a shortage of 90. Add up that. So we need to create 140 rupees by charging the P&L account. So we are going to debit the P&L account with 140 and create the PDD. So the entry here being profit and loss account debit, profit and loss account debit to PDD, to PDD. How much is that? 140. Either you can pass this way or in the previous class we passed this way, right? So PDD account debit to bad debt. The bad debt here being 200 rupees, but we have the PDD in the beginning only 150. The shortage is debited to the P&L account. Okay. And for the next year's requirement being 90, further the entry being P&L account debit to PDD 1990. In both the way we can pass. Both the way we can pass. No issues in that. No issues in that. Okay. So if you club these two, what is the ultimate entry? P&L account 50 and here is 90. If you sum these two, the ultimate value be 140 in P&L account. So P&L account 140 and PDD 150 in the debit and 90 in credit ends with 60 in the debit. Am I right? 60 in the debit. To bad debt. To bad debt. 200 rupees. 200 rupees. If you club these two entry, by the time also you will get the same entry. Okay, PDD account debit, PDD account credit, 200 minus 140 ends with the 60. Bad debt 200 rupees in credit and P&L account 140. So in either way you can pass. You should not have any confusions. Right. So rather than having a ready-made format, understand the logic to pass the entry in whatever the way you are asked in the examination. Is that clear? Now, I don't want to keep this anymore. For the understanding only, this one is given. Right. Apart from that, we need to pass the entry for what? Discount on debtors also. Okay. So, how much discount on debtors we need to maintain? 41 rupees to be maintained. 41 rupees to be maintained. Already we have how much discount? 50 rupees we have the discount. This discount is no more required. Right. This can be adjusted in the provision for discount on debtors. The same way. And we need to create another 41 rupees. We have discount on debtors in the debit side 50. And we have already provision for discount on debtors given in the credit side of the trial balance, which is created in the opening or previous year itself as an opening. This 50 will be adjusted only in the 40 rupees. So I am adjusting that just similar to this entry. Okay, similar to this entry. How we usually charge the bad debt to the PDD? No, the same way. The discount on debtors is routed through the provision on debtors account. So, provision on debtors account debit to discount on debtors. The value being 50. The value being 50. Actually, discount on debtors being 50, but we have the provision of rupees only 40, running short of rupees 10. Am I right? How much we need to create for the next year? Another 41. So, how much we need to debit the P&L account to create the required PDD for the next year? Provision for discount on debtors 51 rupees. I now pass the entry for the provision for discount on debtors to be created in the next year for the requirement of the next year. P&L account debit to provision for discount. Provision for discount. Provision for discount. The value being 51 rupees. 51 rupees. This entry is similar to what? The creation of PDD, like both are same. Now, we have to handle with the reserve for discount on creditors also. Reserve for discount on creditors. Okay. Just erase this. Okay. Now, the reserve for creditors here being reserve for discount on creditors. Already we have how much discount on creditors? 35. That 35 should be first adjusted in which account? Provision for discount on creditors running short of rupees 10 here because of adjustments. 35 should be charged to 25. Of course, the money is not capable of adjusting that, so 10 is there. What is the closing balance we need to maintain? 5% on creditors. So creditors is 10,000 rupees, on that 5% to be created, value being 50. Already there is a shortage of 10 and we need to create another 50. So in total we are in need of 60 rupees to be created for the provision for discount on creditors. For this, the entries are similar to this one, right? Provision for discount on debtors, provision for discount on debtors, you could debit to discount on debtors, right? Similarly, here discount on creditors and provision for discount on creditors will be taken, but it's just inverse, right? Just inverse. Let me see here. Discount on creditors, account debit to provision for discount on creditors. The amount to be adjusted here is 35 rupees. Then next entry being provision required to be created for next year's requirement, similar to this one but inverse. Okay, provision for discount on creditors, account debit to discount on profit and loss account, to P&L account. The value being 60 rupees. Hope you could now understand the passing the entries for all these adjustments. Is that okay? But of course, you no need to pass all these adjustments entries, but it is better to understand. Okay. Now let me incorporate these adjustments in the trial balance, so that the adjustment could have been already incorporated before the preparation of the trial balance. If you could have used all these things, or if you could have passed the entry of these things before the preparation of the trial balance, how could be the trial balance? Let's see here now. One after one. Purchases debit, purchases credit. Debit means you have to add with the purchases, credit should be subtracted. Already we have purchases of rupees 5,000. With that, because of opening stock, 1,000 is added, 3,000 is subtracted. Now the adjusted purchases being 3,000. Adjusted purchases should be 3,000. Opening stock 1,000 rupees in credit. Already opening stock is given in the debit, gets eliminated. We don't have the opening stock. And closing stock, new stock comes in. So rather than opening stock, now it becomes closing stock in the trial balance. So trial balance will not consist of opening stock. Only closing stock might have been included in the trial balance if the entry for the closing stock and opening stock could have been passed, where the opening stock and closing stock could have been routed through the purchases account or sales account, also predominantly purchases account. Of course, there is no harm in adjusting that in the sales account. Okay, logically adjusting in the purchases account is better. And then stationery debit and stationery credit. Debit should be addable, 800 plus 250. Credit should be subtracted, 450 should be subtracted. The ultimate stationery value being 600. Hope so you can understand. And opening stock of stationery 250 in the credit side. Already we have opening stock in the debit side. So this opening stock got eliminated. Instead of that, what we get now? Closing stock of stationery. So rather than opening stock of stationery in the trial balance, now we have closing stock of stationery of rupees 450 in the trial balance. Bad debt account debit. Okay, already bad debt we have 100 rupees in the debit. With that, this 100 rupees is also added. 100 plus 100, 200. 100 here is, 100 here is. So the total value be 200. From there, this bad debt credit should be subtracted. So the bad debt will be eliminated. Hereafter, we don't have the bad debt account. And in case of debtors, we subtract 100 rupees. Originally, we have 1000 rupees because of crediting the debtors account with respect to the bad debts requirement. Now the debtors being only 900. The debtors being only 900. And provision for doubtful debts, debit 200 rupees, credit 140. So naturally, what happens? We have a debit balance of PDD 60. Okay, already we have 150 here. From that 150 rupees credit, this 60 debit is subtracted. Then we will end up with how much? 90. Hope so you could understand. So 150 in the credit side and 200 rupees in the debit side means it should be subtracted, and another 140 should be in the credit side should be added. So by adding by summing and subtracting these three items, you will get the ultimate provision for doubtful debts being 90. Am I right? Are you getting this? Yeah. The next will be profit and loss account 150. Profit and loss. Profit and loss is meant for whom? Owner only now. Whatever the profit or loss we ultimately get, it should be adjusted only in the owner's account. So we can adjust that in the owner's account. Owner's account is named as capital. In that capital, this profit and loss given in the debit side should be subtracted. Right? Debit means subtracted. And another P&L account is also there in the debit side, that should also be subtracted, which is 51. And another P&L account is also available here, 60 in the credit side, that should be addable. Credit means addable, debit means subtracted. If you do all these adjustments, and what could be the closing capital balance here? Come on. 4,869 will be the answer. 4,869 will be the answer here. Okay. Now, discount on debtors 50 rupees. Already we have discount on debtors 50 rupees in the debit. Because of crediting, it gets eliminated. And provision for discount on debtors is there. Provision for discount on debtors, originally 40 rupees in the credit side. And because of this provision for debtors debit, we have to subtract, right? So 50 should be subtracted. And again, provision for discount on debtors given in the credit side should be addable, which is 51 rupees. Credits are added and debits are subtracted. Then ultimate value being 41. Am I right? Will you be getting 41 rupees? So this is now converted into 41. This is now converted into 41. Right. Now, discount on creditors debit. Already discount on creditors in credit side we have 35. Now it gets eliminated completely. This will be eliminated. And provision for creditors 35. See here, provision for creditors being given in the debit side 25. And because of this provision for creditors in the credit, it should be subtracted, right? 35 should be subtracted. Again, provision for creditors given in the debit side should be addable. Should be addable. The value being, this value being 60, right? Yeah. So what is the ultimate value? 70. Is the last one is 60 correct or not? Yeah. What is the ultimate value? 50 rupees. Okay. 50 rupees will be the value. I'll change this to 50. Okay. This is 50. Hope you could now understand. Now if I prepare the trial balance, this trial balance is called adjusted trial balance. This trial balance is called adjusted trial balance. Come on, get me the adjusted trial balance value here. Make it faster. Make it faster. What's the value? Totally done. Use the calculator. Make it faster. Use the calculator, man. It's not possible to calculate that mentally. So many numbers. Debit. Debit side?
18,000.
Exactly 18,000. Also 18,000. It matches, right? It matches. See, this is called adjusted trial balance. Okay. You can pass the, probably you can pass the, this one, adjust means transfer entry, and you can post this also. You can post it. Okay. I'll just do some adjustment here. Now, for what we have to pass a transfer entry. Those nominal accounts will be routed through transfer entry. For the all the real and personal account will be directly written in the balance sheet. Right. Let's see here. Trading and P&L account, and then balance sheet. And then balance sheet. Okay. Now, trading and P&L account, and then balance sheet. Actually, we have to pass a transfer entry and then you post this. But I'll just directly post this and then I will pass the transfer entry later. Come on. Purchases, carriage in. These two will be what? Items debited to the trading account. So the entry being purchases account debit, purchases should be in the debit side, value is 3,000. Carriage in, the value being 1,000. Admin, selling expenses, both will be debited to P&L account. Admin 1,000 rupees, selling 1,000 rupees. Fixed assets, investment, debtors, cash, stationery, stock of stationery, except stationery. Okay. These things are assets, so I put that value in the asset side. Right, in the asset side. Fixed assets, the value being 4,000. Investments, the value being 2,000. Debtors 900 in the inner column because it has two adjustments: provision for discount on debtors and provision for doubtful debts. Okay, and I just leave the space here: PDD as well as provision for discount. Provision for discount. Then we have cash. The cash value being 1,000. What about stationery? Stationery and expenses should be debited to P&L account. Consumption of stationery 600. And closing stock of stationery, closing stock, and provision for discount on creditors. First of all, we will try to finish up these two: closing stock of stationery and closing stock. Both our assets will be posted in the asset side of the balance sheet. Closing stock of stationery, closing stationery. The value being 450. How much is that? 450. And stock in trade, that closing stock of material meant for business is always named as stock in trade. The value being 3,000. And provision for discount on creditors should be adjusted from the creditors. So creditors account, from there we have to subtract the provision for discount on creditors. 50. Provision for discount. Debit side over. In credit side we have sales. Sales should be in the trading account, the value being 8,000. And capital here 4,869. 10% loan creditors, both are liability. 10% loan, the value being 4,869. Oh, okay, 4,000. Creditors being 1,000, from there 1,000 is 50 rupees is subtracted, so 950 is the ultimate value. Provision for doubtful debts and provision for discount on debtors, already left the space for that. 90 and 41. What is the ultimate value?
769.
769. 769. Discount on creditors was already eliminated. We don't have the discount on creditors at all. Right, eliminated already. Now, if I want to pass a transfer entry, the transfer entries are for what? Only the items recorded in the trading and P&L account, right? So I just pass the transfer entry for the items given in the credit side. So for that, the journal entry being credit side of the trading account. The entry being sales account debit. Sales account debit to what? Trading account. What is the value? 8,000. And trading account debit items, purchases and carriage. What is the journal entry for that? Very good. So trading account debit to purchases to carriage in. The value being 4,000, 3,000 for purchases and 1,000 is for carriage in. Then the entry for admin and selling and distribution. Yeah. P&L account debit. P&L account debit to admin to selling to stationery. The value being 1,000, 1,600, 2,600. Now tally the trading and P&L account. 8,000, 8,000, 4,000 should be GP. Now if I tally this, 1,400 should be transferable to a balance sheet addable with the capital 1,400. For the GP, journal entry being what? Yes, GP, trading to GP and GP to P&L account are simply okay. P&L account debit to, what's the entry here? P&L account debit or what is the entry? Trading to GP and GP to P&L account. Then ultimate entry being trading account debit to P&L account. The value being 4,000. Finally, whatever the balance available in P&L account is transferred to capital account for the journal entry being P&L account debit to capital. This value being 1,400. So you have to be strong with the transfer entries also. So at the professional level, in most of the advanced sums, no, you will have such a calculations also. Come on, get me the balance sheet total. What about the total of capital? Is it 6,269? Okay, 6,269. If you total this, 11,219. 11,219. I have not skipped any routes. I explained everything in a proper channel. For your examination, of course, you no need to do this way. Okay, you can directly work out as you think. Now, the question is, if the provision for discount and returns given in the credit side of the trial balance, what you have to do? Only that one. Only that one. Provision for doubtful debts as well as provision for discount and returns available. What does it mean? All the adjustment related to the bad debt and the discount and returns over. The provision given in the trial balance is nothing but for the next year. That will directly go to the balance sheet. See, whenever any adjustment items appear in the trial balance, it will go to only one place. It will go to only one place. You have to be careful with that. So here I have explained that in detail. In subsequent learning at the professional level, no. Most of the times the questions may be surprising. Some of the adjustments could have been incorporated in the trial balance itself. So you may be surprised why the closing stock comes inside the trial balance. Why the provision for doubtful debts comes only in the trial balance without any bad debt or any provision for any discount and returns. Then how do I handle that? Now all these questions could be addressed by learning this way of passing journal entry and preparing the adjusted trial balance and going for the final notes. Of course, for the examination, you can skip these points directly. You can prepare the trading and P&L and then balance sheet. Okay. Come on, if you want to make a copy of this, make it faster.